Yeah, I will try to skip most of the world demand indicators because there have already been so many speakers today who have covered these areas. But I think before we get started with the world, with the container demand, there's one thing I would like you to recall. I'll not talk much about the crisis, but I think it's worth paying attention to and recalling that Asia and the Asian economies have contributed 2/3 of the global growth since 2008. So without the Asian economies today, much shipping would have been significantly worse than we are facing today. And there is good news, of course. I think the primarily good news today, as we heard this morning from one of the Citibank guys, was that the global economy is recovering. We are out of the recession. We do not face any nearby currency crisis. Trade volumes are above pre-crisis levels, but still we need to see some more. We need to see the growth generating some more employment before we can really conclude that the current recovery is sustainable. But we could discuss this a lot. But as a topic today is container demand. My final remark for the global economy will be that the global growth has come out of Asia. That is not particularly good news for container demand, as Asian demand is primarily on a backhaul leg here. So clearly, on a broad perspective, Asian demand is fantastic for the global economy and for shipping in general, not to mention product tankers and dry bulks. But for containers, it's less of an advantage than what we have seen in other segments. This graph here just recalls to all of us the development for world trade volumes. I think it's worth paying attention to the relatively modest growth we have had the last few years. Clearly, we had a recap period where both demand picked up, but also inventory was rebuilt. But compared to a fleet growth that was mainly based on the expectation that this kind of growth would continue in the period 2008 to 2013, we clearly have an output gap here. There's much more capacity in the container segment than what is in demand, and the same is true as we have heard today for both dry bulks and tankers. But the good news is we are above pre-crisis levels in most segments. Good. This graph here is, to me, a great importance because it tells us again that production moves closer to consumers. For containers, this is not a good news again because, first of all, it's a backhaul leg, and then intra-Asian trade creates much less ton-mile demand than if the same growth has come out of North America and Europe. But it's important to recall that without Asia, this has been difficult. Good. And now we will take a look at the container segment. I have tried, as I started to say, to make this presentation as simple as possible. Please ask me a more detailed question if it's too much. I think it's worth to pay attention to the fact that container import volume growth really strong in the period 2003 to 2008. We have had an annual growth of around 11% in a period, 1 year after another, on average, of course. But since the economic crisis have hit, and this is primarily head-haul demand growth, since the economic crisis hit, the growth has slowed to an annual growth rate of 3%. Clearly, a lot of other industries would be happy to see 3 percentage points growth in a time of crisis. But compared to the inflow of new vessels, this has created a lot of the troubles we are facing today. Container demand is clearly much more than just import volumes. It's also a lot about travel distances, as we all know. In the period from 2009 to 2008, we have a lot of offshoring of production, where we move production to the east, either to China or to other Asian economies. Since the economic crisis hit, we have seen very little renewed offshoring of manufacturing, but in fact we have seen some manufacturing moving closer to consumers again. A lot of, in particular in the US, are discussing issues what they call reshoring. That is the risk that production is moving back to North America, or at least closer to North America, and the same is true for European economies. We are also discussing if it could be possible to have more manufacturing done in the east and in the south of Europe. These trends is at the moment only at the very, very beginning, but if you take more hold in the economies, it will be really, really challenging time for the container business. But so far, it is only a small. It has reduced the average travel distance by 0.5 percentage point in the period from 8 to 12, not 13. So clearly, vessels have been sailing at much lower speeds, trying to reduce the gap between supply and demand, but the combination of a low import volume growth and shorter travel distances is a very, very difficult cocktail for the container industry. This figure might look a little bit exaggerated, but in fact it is just showing the actual figures. What I've shown here is post-Panamax fleet demand on an annual growth basis once again. I mean, very few segments can absorb annual growth rate in the period from 2003 to 2013 about 20%. When capacity growth more than 20% every year, it has more than doubled in only 5 years or so. So this is very few segments at all, no matter what kind of segments we are looking in, can handle this kind of supply growth. I mean, if you look at the global world fleet, the global world fleet has in the same period increased something like 45% compared to demand growth of 15%. So clearly we have a nominal output gap of 30%, at least in growth rate terms, but post-Panamax vessels are at the center of this problem. The fleet has been increasing fiercely in the last few years and seems to continue to do so. So slow steaming, cascading, and the consequence of cascading is to deploy larger vessels on routes that cannot necessarily absorb all the capacity into it. It provides no salvation for the industry. It at best try to make it less negative. We have a huge output gap in this industry. I'm quite sure that the German markets are much more aware of this than we would like to think of. Yes. I will not spend a lot of time on discussing freight rates. I mean, in a time of significant overcapacity, one of the first great news here is that we still have volatile freight rates. If overcapacity becomes too large, freight rates will become more or less flat on a very, very low level. As long as we can see some volatility for one reason or another, we still have some kind of market mechanism working for us. It is at least good news that we have some periods of relatively high freight rates, box rates. Clearly this is not a picture of an industry that's prospering. It is clearly a picture of an industry that struggles. But I mean, in these days it is worth remembering that as long as we have volatility in freight rates in a market with such an overcapacity, it is in fact somehow news. We do have spikes of fairly good earnings. And again, I'm a banker, so even few months of fairly good freight rates will enable some owners to keep basically be able to repay some of the debt, and that is always a good news. Yeah. I'll try to go quite fast through this because it is in fact quite simple. We just have too many vessels, but let's try to look a little bit of the outlook. This must be a mistake. I will just skip it. But no, I'm pressing the one button. Continue to do so. Sorry. We've spent the last few months, maybe even a year and a half or so, discussing with various ship owners when is the right time to buy a vessel, and not at least when to decide if a vessel purchase is a good investment or not. Clearly, from the bank's perspective, we have what we can say an unlimited downside in asset values. The best that can happen for us is to have our debt repaid. So we will always be a bit more cautious than ship owners. But I have to admit, I do not fairly understand the arguments. And I'm doing it again. That's really fantastic. I fairly do not understand the arguments behind continuing purchasing new, extremely large vessels in a market oversupplied with super large post-Panamax vessels and an order book that is still more than able to facilitate future demand for the foreseeable future. But even though we still see super large post-Panamax vessels contracted, and even with very, very short delivery times, I think the latest contract we've seen from China shipping was with a delivery time of less than 18 months. To a banker, this is quite scary news that we will continuing adding pressure on the current market. If we look at the post-Panamax fleet, it is quite obvious that we have almost non-obvious scrapping candidates for the age of 20 years or older. And we have a fleet order book ratio of 35%. And in a market where we already have an overcapacity, we will have to scrap really, really young vessels if scrapping activity is to balance supply and demand in the next few years. Or at least if the global post-Panamax fleet is to be operated at, let's say, 60-70% of utilization when this order book has been delivered. It is very, very difficult to see even significant cascading, the continuing of slow steaming to provide any salvation if this order book is being delivered. Yes, it's not necessarily good news. We're quite worried about it, but yeah, hopefully some people can see something I can't. This graph here, I have tried to make. In fact, it is one of the most positive scrapping scenarios I've been able to build, even though it's not that positive. And scrap every vessel before the age of 20 years. The year before it turns 20, so the year before it has to go into the fourth special survey. The vessel is scrapped. Clearly, we could lower the age until 15 or even lower. But if we recall the age distribution of the post-Panamax fleet, we'll have to scrap really, really young vessels if we should by any means match the annual inflow of vessels. So, I mean, the point here is that scrapping of older vessels will not be any short-term, will not provide any short-term salvation for the post-Panamax fleet. I cannot see much other choices than to run all the new large vessels on relatively low utilization rates, and hopefully the marginal cost per move to TU will be sufficiently low so it will make sense. We hope, at least. Looking ahead, and this is a bit miscalculating, even though I like it, that's because it shows a little bit of a positive figure. Looking ahead to 2018, we only have an annual fleet growth of 8%. The reason why this figure is a bit misleading is because we only have order books 2 years ahead. So basically, I have taken no assumption for any further contracting activity that may happen from today and the next years ahead. And clearly, new contracting activity will impact this figure, so it will increase. But I mean, if we cross our fingers and hope that most of the appetite for new vessels has been satisfied these days, this could in fact be an outcome, and this would mean that we could take the first steps in improving the market balance for post-Panamax vessels from 2014 and years going forward. If it is likely to happen, I'm less certain, but from the point of view, I think it's nice to recall that if we stop everything now, we could start to move in a more positive direction. Even though the demand outlook also is quite low. The big joker here is clearly when will Europe come out of the current recession? It seems clear to all that in a period where there is so much uncertainty to the European economy, it will be unlikely, and Asia-Europe being the largest head-haul route, it seems unlikely that any forecasts will point in a direction that Europe will take a large contribution in annual growth for the foreseeable future. So I mean, if we manage to handle the economic crisis in Europe to an extent where European container imports will increase, this figure might undershoot actual demand growth. Then again, we have another dark horse, and I started to introduce it in the beginning, reshoring, the trend where we consider to move back manufacturing production either closer to Europe or closer to North America. Clearly, any significant reshoring activity will lower the annual growth numbers and will impact the major head-haul routes. As we all know, most operators optimize the size of their fleet on the main head-haul routes. So the head-haul backhaul ratio might risk to continue to be really, really imbalanced for the next years ahead as well. That was in fact my short presentation. I'm sorry for the lack of more details, but I mean, the picture is quite clear, at least from my perspective, so there's no reason to give too many slides on showing all the difficult times for all the main head-haul importing regions. So please feel free to give questions if you need some more detailed research, or feel free to download our report.
Thank you, Christopher. Last but certainly not least, and hopefully with better news than all the rest, we have KristofferLund Sandaker, who I have to thank even more than the other speakers, because he's stepping to replace his colleague Peter Wallace, who wasn't able to attend, so thank you for volunteering. KristofferLund Sandaker is from Moderator Project Finance, and he will give us his views on the offshore sector.
Did you walk away with the, or is this the...
Probably the... No, it's me.
Oh yeah, that is. Thank you. Well, yes, thank you very much. And unfortunately, my colleague Peter Wallace wasn't able to be here today, but I'm very happy to step into his place, and it's a pleasure to be here. The topic for today is offshore and shipping, entry points and opportunities. There were some challenging questions posed. I saw that when I looked at the agenda. Where to invest, when to invest, and is timing everything? I think we all wish we knew that exactly, but I think the best we can hope for is to make some more or less informed decisions. Just to put my presentation in a little bit of context, it could be useful to explain a little bit of who I am for those who don't know us. Pareto Project Finance is part of the Pareto Group of Norway. What we do is, as the name suggests, project financing and facilitating direct investments into shipping and offshore assets. So usually what happens is that we set up a special purpose company that acquire assets, and then we finance these assets or special purpose companies with debt and equity. Debt from banks and equity from different investors. These are one of the structures. The sort of joint venture co-investment model, where you have basically full market exposure as an investor. To another part of the spectrum, which is the sale-leaseback, where depending on how long the bareboat charter is or the charter back is, the risks are divided between the investors and the actual charter or operator of the vessel. So the deal flow over the past few years have been quite good, both within offshore and shipping, and we've actually done quite a lot of business in the Greek market. But that was actually mostly before 2008. And why was that? Well, looking at the composition of our portfolio, which is the special purpose companies that we have arranged and that we manage and follow up, we see that the size of the portfolio was roughly the same from 2006 until 2013. But the size of shipping was reduced significantly, and the size of offshore increased. So was this due to good timing? Well, first of all, it was in structured deals. It has been much easier to make sense of the numbers versus the values versus the rates in the offshore segment than in traditional shipping. And it's been easier to be enthusiastic about the demand fundamentals in the offshore sector. I'll touch upon that a little bit later. So, when to invest? The wheel of fortune. Oh, nice. It's, of course, the shipping market, as well as to a certain degree the offshore market, is quite cyclical. So, timing is definitely important, and the greatest fortunes are won and lost on timing the market. We believe now that we're somewhere in a recovery phase, which is ideally where you would like to get in as an investor. Unfortunately, though, it's not where most people get in. They usually get in at this lower left part of this circle, the boom. In the boom years, capital is abundant. The investors are throwing money at deals, and one would think we'd actually learn. But on a personal level, we might take some wisdom, but on an aggregate level, we never really do, and history tends to repeat itself. So get in early. That's at least better than getting in during the boom years. So yes, we think that the timing is good right now. There are some pretty unique opportunities in today's market if you look for them. There's sign that the global economy is improving. The ships and offshore asset values are relatively low, and there are few buyers and lack of financing. Rates are starting to pick up in some segments, at least the LPG, offshore, LNG segments are sort of lighter points. Lower values and higher earnings, that's actually something we've seen in some segments, particularly within the offshore sector for the past years, where lack of financing and lack of capital actually caused values to go down, while earnings in the segment have actually been positive or rising. And capital is scarce and can be expensive, so there are opportunities to those with access to that. So the picture at the end of 2012 were a little bit depressing for many segments. LNG obviously had a very good year, but the euphoria kind of waned off. We're a little bit subdued at the end of the year. In the offshore sector, the picture has been a little bit better. Of course, these slides are subject to debate, but in the offshore sector, particularly the rig market has been very strong. As well as actually the mid-size PSVs and the anchor-handlers, or even the low-end segments, have actually been performing significantly better than the high-end vessels. The North Sea vessels are obviously much more expensive, while the easier to operate, the easier vessels, the mid-size, the low-end vessels, are cheaper to buy and have had a better market in Asia, West Africa, and the Middle East. So, speaking of offshore, there have been many good presentations today about the shipping market. I thought I'd weigh in a little bit about why we think the offshore market is so promising. Of course, the offshore market is very fragmented, and I won't go into very much detail. But overall, the difference from the different shipping segments and the offshore market is that whereas in shipping you have in different segments a lot of different demand fundamentals, the offshore sector relies quite heavily on a single demand factor, which is obviously the price of the output from offshore drilling. So here it's represented by the price of oil. And as you can see on this graph, the oil price has been high high before, so what's to keep this from falling in the future? Well, first of all, whereas in the 70s you had supply disruptions such as the Iran-Iraq War, the Iranian Revolution, the Yom Kippur War that caused huge disruptions in the supply, you've had for the past 1.5 decades pretty fundamental changes on the demand side. Here is a good illustration, the tenfold increase in Chinese oil imports over the past decade. And it's not only China that has shown this pattern, but going forward the growth, as it has been over the past 1.5 decades, will not come from the West, it will come from the non-OECD countries. And this growth rates of the population are obviously higher in the non-OECD countries, which accounts for some of the demand increase, but there's also a lot of potential in increased per capita consumption as the economies grow on a per capita basis. So yes, we're still going to demand oil. Here are 5 different projections, all showing that oil demand is growing rather briskly from until 2030. But what about tight oil? As you've probably heard a lot about, the shale oil revolution, oil sands and unconventional oil sources that you hear about a lot. Here are one of the most bullish estimates of the US shale oil supply or reserves. And it's true, I mean, the supply from tight oil is expected to increase on an incredible scale, from being only marginal to reaching 5 million barrels, as this projection shows, or even as high as 9 million barrels on a global level by 2030. I mean, 9 million barrels per day, that's quite a big number. That's about 10% of the global oil demand that we have today. So it seems quite high. But is it really a threat to the offshore industry? And no, most likely it isn't, because the problem that we have with oil today is that the oil we're producing or consuming today has been found 40, 50 and 60 years ago, and existing reserves are actually depleting on a massive scale. So here you see those 9 million barrels per day, which is the tight oil expected supply in 2030. But we still need to cover that decrease in production from existing production. So we need huge investments going into finding new oil fields, and a lot of those investments will go towards the offshore market. I mean, we're talking about the oil, increased demand for oil, but we don't really need it. I mean, the offshore market is driven by actually declining production of oil, which needs us to find oil elsewhere. And we actually have increased investments into the offshore sector quite significantly over the past decade, 1.5 decade. Investments into offshore exploration and production have increased by an average of 13.5% per year, while in the meantime global oil production have only increased by a measly 1.8% per year. So it's virtually nothing. Of course, in this period, offshore's share of the global production have increased. And going forward, there will still be huge investments into the offshore sector. These are the oil majors' own projections of how much they will spend on exploration and production in 2013 and 14. And with a double-digit growth from previous years, this is going to be a huge demand booster for the entire offshore service industry. And there is a very great correlation between investments going into exploration and production and the demand side for the offshore service industry. Here we see that drilling activity, supply vessel activity and seismic activity is at really all-time high levels. And the reason for the underperformance in some of these offshore segments for the past few years should be quite familiar for anyone, associated with the shipping industry. There have just been too many vessel deliveries. However, going forward, the supply side is actually beginning to look much more manageable. These are the high-end segments, but in some of the more lower-end segments, especially on the support vessel side, it looks even better. And you must remember that a huge fleet expansion have taken place since 2008, and much of this has been absorbed by the market without creating the same really distressed levels that you've seen in some shipping segments. So we think that the deals that we do today is going to be pretty well timed. To this year we've done 2 sale-leasebacks on the offshore side, new building assets, play opportunity on the offshore side as well, set up a new company within the ERRV sector, which is a kind of an emergency response sector of the North Sea, and a new building project on the handysize side. So in total it's been about bit over $300 million worth of assets. So speaking of where to invest, I saw that the question for the debate in the next round or one of the questions were whether you should invest in real assets or in paper, in bonds. And in our experience, investing in the actual assets, ownership of the vessels, are tremendously important. Here are some of the projects that we've done with a few listed counterparts which have suffered through some tough times. There are 3 particular companies here that have struggled a little bit: Ice and Chemical, RXT and Marine Subsea, where the equity holders have basically lost all their equity. Both the unsecured and the secured bond holders have taken huge losses, while actually the investors that went into the project where the vessels were chartered to these companies have actually done tremendously well. And the proof is also in the performance of the portfolio, which is very asset-based. Over the past 10 years, it's been a 19% annualized return if you invested in every single project, and that has outperformed both the equity and the bond markets. So the projects that we look at are, some cases opportunistic, some cases more credit deals. Here's an example of the latter, Norseman Offshore, which was a sale-leaseback that we did with a Scandinavian company in early or right before Christmas. In this particular deal, we had a put option to sell the vessel back to the charterer, which gave the investors an IRR of 10%, so kind of a minimum return. In addition to that, you have some seller's credit as collateral in the vessel, and of course further upside in the general market. The call option would provide the investors with a return of 18%, and there was a profit split on top of that as well, if the values were even higher. So where would you put your money? The interesting thing is that Viking actually had unsecured bonds outstanding, yielding about 9.7%. Whereas in this particular project, you got running dividend yields of 17%. And also from an equity perspective, the transaction was good, at least compared to other listed offshore companies that obviously have much more higher degree of commercial risk, which is here borne by the charter. So which cash flow would you actually want? This is the cash flow from the bond of Viking, where you see that the performance of the bond obviously relies quite heavily on the counterparty's ability to repay the principal. And this is a 5-year bond. If you look at the cash flow from the Norseman project, not only is running dividend yields actually higher than in the bond scenario, so you after 5 years, should the charter disappear, you have almost gotten your equity back, but you actually have the vessel. Whereas in the top scenario, the bond scenario, you're completely unsecured and you don't have any vessel to sell if your counterparty goes away. But on such a sale-leaseback, is there such thing as a win-win scenario? We just raised equity for us on another sale-leaseback within the offshore sector against a listed counterpart. They had a market cap of about $800 million. And they just raised bonds, unsecured bonds, for less than 5% interest. It was a 10-year deal for our investors and at quite attractive terms. So why would this counterpart actually do this? Well, they're getting close to 100% financing, and they're earning money on these vessels in the market. These are offshore vessels. So they're actually just investing. It's a zero-sum investment for them, and they're happy to take the commercial risk on the assets. In addition, of course, they release a lot of equity, and the funds that they get out of the sale-leaseback can be levered and used to fuel growth, because it's a completely off-balance sheet transaction, and it doesn't really take any capacity from their balance sheets. And this is a company that have used this method to grow quite substantially in the past, and it's been quite successful for them. So quickly, what drives the pricing of such a deal? Of course, you have the asset, how specialized it is, the counterpart, and the quality, the structure of the deal, whether there is seller's credit, how the underlying market is performing, or how the bareboat rate or charter rate is in relation to that market. And of course the general cost of capital in the market. So it's timing everything. To say that it's everything might be a little bit harsh. But it definitely helps. It depends on the structure, and one has to have the ability to actually be able to seize the opportunities that present itself. But of course, going into whether you're buying new buildings or buying second-hand, or whether you're participating in a structured deal where you have perhaps a charter attached, going in at this level, at these low values, depressed values, both on the new building side and on the second-hand side, that is really a reduction in the downside in itself. So that's all for me, actually. So thank you for your attention.
Thank you for building. Right. Shall we open up to any questions from the audience? And I'll kickstart that by asking you, how high up, coming from group shipping, where bulk shipping is very straightforward investment, and a number of ex-captains have become ship owners. How high are the entry barriers in the offshore segment? Other than simple financing or equity, do you need any other elements to be able to access?
Well, it depends quite heavily on the segment, because offshore sector is everything from the simplest, bread and butter pickup trucks, which is the supply vessels, to the anchor handlers, which is a little bit more complex, and then you have at the other end of the scale very purpose-built subsea construction vessels, well intervention vessels. So, the higher you move up on that scale, the higher are the barriers of entry, because you need a lot of that engineering expertise to actually operate these vessels. And that is somewhat the reason to why perhaps the PSV market has underperformed a little bit, because it's been easier to order those vessels rather than ordering, something that is a little bit more high-end. But there are examples of people that have been burnt. One of the companies that Marine Subsea, which we had a couple of our accommodation barges to, that was a company that had a very good accommodation barge business and contracts to oil majors. Then they decided to build 2 well intervention vessels. and with disastrous results, which basically turned the whole company bankrupt. So sometimes you need to stick to what you already know, but yeah.
Thank you. On the container industry, you clearly showed us a very dynamic expansion of the fleet. It doesn't seem to be balanced by expected growth. Given also the oligopolistic, let's say, structure of this, and also the fact that some of the larger players are, quasi-state entities, do you see a repetition of the price war that we had before? Do you see any further consolidation? This is clearly a market which don't have the perfect economics you have in bulk shipping. Do you see any impact of this?
I think it would be necessary in a few years to have some kind of consolidation in the market. A few of the current players will be able to maintain on an individual basis the kind of capacity expansion, and also the gap between the largest and the smaller gets wider and wider. So something will have to happen. Just read Lloyd's list in lunch break. Mr. Pondit told that he will not be stepping up in any investments soon. He will not be a candidate for acquiring any other. I think one of the smaller ones might take advantage of going together. I think it would be
so a two-segment market, large players and small.
Could be, yes. Option.
Thank you. Any other questions? Can't let us know the organization you come from.
Okay. So, sorry, you mentioned that one of the companies was successfully able to do sell and leasebacks, and because all that is off balance sheet. As you may be aware, there's a proposed guidance coming relating to getting all leases back onto balance sheet. The recent exposure draft was actually re-exposed now in May. What implications do you think that this will have on the shipping industry?
Well, it's difficult to say how much implications it will have on the entire shipping industry. I believe it's a little bit different, relative to what jurisdiction you're based in, whether one will be affected by some of these problems. But of course, for many different players doing these kinds of transactions, it has been a good point for them that it has been off balance sheet. And usually they spend a lot of resources on accountants, on people that can evaluate this and sort of vouch for the fact that it will be an off-balance sheet transaction. But it depends a lot on the structure of the transaction as well, how much of the total cash flow is actually being paid by the charterer, how long is it, or is it a more deal with where the investors take a little bit more market exposure. So it's not really black and white whether all these kinds of sale-leaseback deals will actually be considered a kind of on-balance sheet transaction. But it will be interesting to see whether it will have a huge impact or not. Obviously, some of the good thing about having it off balance is that you don't really use any balance sheet capacity.